Assalamualaikum warahmatullahi wabarakatuh to Madam Gianti. We are from Group 5 and will be presenting on integrated reporting. Before I move further, I would like to introduce my group member. It consists of Muhammad AKMAL HAFIZZUDIN bin NOOR Azwad, myself, Nur Aifana binti Muhammad FITRI, Nur Aisyah Zulaikha binti SUFIE, NURUL FARAH NABILAH binti SHAHIDAN, and the last one is Nur HAZWANI binti MASRIZAL. Before I start, let's take a look on this video.
Alright, so for a number of years now, you've been preparing separate reports. Right now, you prepare a report for regulatory purposes, which includes a review of your business. You also prepare another report, often voluntarily, which you may call the Sustainability Report or Corporate Social Responsibility Report. Your regulatory report provides an account for the year and a statement of health at the year end for owners and loan providers. Your other report considers the impacts of your business strategy and behaviours for a broader spectrum of interested parties: customers, employees, NGOs, governments, society at large. Sometimes different teams and different managers write these reports, and sometimes at different times. This gives a high possibility for different information sets and different terminology, but for the same business. That's why integrated reporting is here.
So, what is integrated reporting? Integrated reporting brings together material information about an organization's strategy, governance, performance, and prospect in a way that reflects the commercial, social, and environmental context within which it operates. Integrated reporting is an evolution of corporate reporting, emphasizing on conciseness, strategic relevance, and future orientations. Due to the emergence of information technology and the globalization of economies, the environment in which accountants work is rapidly changing. For years, businesses have been held back by market focus on the short term, a lack of long-term thinking, and a shortage of information on the true sources of reliable value creations in a company over time, such as innovations, brand equity, customer loyalty, and key stakeholder relationship. Fortunately, there is integrated reporting, which is a tool to help businesses understand, manage, and communicate about the sources of value creations, and has brought about significant changes to the accounting professions by reshaping the way companies communicate their performance and value creations to stakeholders. Integrated reporting incorporates not only financial metrics but also consider environmental, social, and governance factors, reflecting a broader understanding of a company's value creations. While the accounting rules was restricted to the provisions of financial data and analysis, in the current climate, more and more investors demand non-financial data when screening a company. Therefore, businesses are expected to report not just on the profit but on their impact on the wider economy, society, and the environment. In this context, integrated reporting comes handy as it gives a dashboard of an organization's activities and performance in this broader information flow. In modern companies, it requires the applications of technology to the transitions from the current model of management practice and corporate reporting to an integrated view. For this slide, I will talk about the key issues. There are a few key issues that we have figured out from this case study on the integrated reporting. The major issues in the voluntary adoptions of integrated reporting are creating a smooth adoptions and relevancy to the mainstream business and investor communities. This issue arises when integrated reporting requires a cultural shift within organizations. Moving from a narrow focus on financial metrics to a more holistic and interconnected reporting approach may encounter resistance from entrenched reporting practices and new established organizational cultures. Not only that, the absence of regulatory mandates or incentive for integrated reporting may limit its adoptions. Companies often prioritize activities that are required by regulations, and the absence of regulatory push may result in a slower adoption rate. Next issue is regulatory overloads, and with limited talent to serve the corporations, adopting integrated reporting might not be feasible. The coexistence of various reporting standards, including MPRS, IFRS and Companies Act 2016 creates a complex regulatory environment. Corporations are required to comply with multiple sets of rules, each with its own specific requirements, making the regulatory landscape more challenging to navigate. The adoptions of new reporting standards, especially those that involve a more holistic approach like integrated reporting, requires a specific set of skills and expertise. A limited pool of professionals with the necessary knowledge in integrated reporting may hinder corporations from effectively embracing this new reporting. The third issue is operationals and of integrated reporting by setting appropriate organizational key performance index, identifying appropriate organizational risk indicator, lack of measurements of non-financial data such as strategy, environmental and societal impacts, and a lack of market prices for many natural capital assets and services. Company might view integrated reporting as an additional reporting burden, which requiring more time, resources, and also effort. The perceived complexity and resource intensiveness of integrated reporting may deter integrated reporting adoptions. For better illustrations, defining and selecting key performance indicators that effectively capture and communicate an organization's performance can be harder. Determining which metrics are truly key to demonstrating value creations and aligning with strategic goals requires careful considerations. Therefore, inaccurate or insufficiently relevant key performance indicators may result in a mispresentation of the organization's performance and also potentially leading to a lack of confidence from stakeholders. Then, for the next slide, I will pass to the next presenter, HAZWANI.
Thank you, Farhana. My name is HAZWANI binti MASRIZAL, and I will continue the presentation. The emergence of integrated reporting can be justified based on several factors. The first one is integrated reporting was developed as a response to the limitation of traditional financial reporting, which only focused on financial performance and did not provide a comprehensive view of an organization's value creation and impact. Integrated reporting integrates financial, environmental, social, and governance information into a single report, providing a holistic and a comprehensive view of an organization's performance and strategy. Second factor is there is a growing demand from stakeholders for greater transparency and accountability in corporate reporting. Integrated reporting provides a framework for organizations to disclose relevant and material information about their strategy, performance, risks, and impacts on society and the environment. Accountability and transparency are very important for establishing trust and maintaining positive relationships. Companies that are openly share about the both financial and non-financial information are more likely to gain trust from stakeholders. Next is adaptation to changing business environment. Adaptation to changing business environment is also important for organizations to thrive in today's dynamic landscape. The business environment has indeed changed or developed significantly, presenting business with complex challenges such as climate change, resource scarcity, social inequality, and technological disruptions. Integrated reporting help organizations understand and communicate how they are managing these challenges and creating value over the short, medium, and long term. The fourth factor is increasing in the stakeholders' expectations. Stakeholders, including investors, customers, employees, regulators, and the general public, now expect more from companies than just financial performance. They want to see how business contribute to the society, how they manage risks and opportunities, and how they operate ethically and sustainably. Integrated reporting provides a platform to fulfill these expectations. The last one is regulatory trends and standards. Changing in regulatory environment, along with the development of international standards such as the International Integrated Reporting Framework, encourage organizations to adopt integrated reporting, and compliance with these standards enhance credibility and comparability of reports across different entities and organizations. Now, let's move on to the next slide. Next is the justification on how the emergence of integrated reporting works. The emergence of integrated reporting provides modern approach and tools to communicate with stakeholders and also as tools towards sustainability. As for the first one, which is modern approach, integrated reporting introduced a more holistic and a comprehensive approach to reporting by considering not only financial performance but also non-financial aspects such as environmental, social, governance, which known as ESG factors. And this modern approach recognizes that financial performance alone does not provide a complete picture of a company's value creation and a long-term sustainability. By integrating financial and non-financial information, integrated reporting enables organizations to better understand and communicate their overall performance and value creation to the stakeholders. Second one is integrated reporting provides organizations with a framework and tools to effectively communicate with stakeholders by presenting a clear and concise overview of the organization's strategy, business model, and performance. Integrated reporting enables stakeholders to gain a better understanding of the organization's value creation process and its impact on various capitals, including financial, manufactured, intellectual, human, social, and relationship, also environmental. And these enhance communication, build trust and transparency with stakeholders, and fostering a stronger relationship and engagement. For instance, consider technology company employing sustainable practices, including reduced carbon emission and ethical supply chain management. In a traditional report, these efforts might be overshadowed by the financial figures. However, integrated reporting allows the company to showcase its commitment to environmental, social, and governance factors alongside financial data. This transparency not only informs stakeholders about the company's sustainable operations, but it also emphasizes long-term value creation that goes beyond monetary measurements. The last one is as tools towards sustainability. Integrated reporting encourages organizations to consider sustainability as a core aspect of their business strategy and operations by considering financial, environmental, social, and governance aspects. By integrating sustainability-related information, this enables them to make informed decisions and take actions that contributes to the long-term value creation and sustainable development. For instance, a company in the energy sector may use integrated reporting to disclose not only its financial performance but also its effort to promote renewable energy sources, ensure employee safety, and engage with local communities. By providing a comprehensive view of its sustainability practices, the company can demonstrate its commitment to sustainable development and attract investors and stakeholders who prioritize the sustainability. Next, I will pass this presentation to the next presenter, Aisyah Zulaikha.
Hi, my name is Zulaikha and I will be presenting the challenges and opportunities of internal reporting. The challenges are: first, regulatory challenges, where the absence of regulatory mandates or incentive, where the lack of regulatory push for integrated reporting may result in companies prioritizing other regulatory requirement over the voluntary adoption of IR. Next is the complex regulatory environment, where the coexistence of various reporting standards, including MPERS, FRS, and Companies Act 2016, creates a complex regulatory landscape. The analysis is that regulatory incentive can significantly influence corporate behavior. Government may consider providing tax incentive or other benefits to companies that voluntarily adopt IR, encouraging broader adoption. Streamlining the regulatory environment by harmonizing reporting standards can reduce the complexity. This requires collaboration between regulatory bodies, industry stakeholders, and standard-setting organizations to create a more conducive environment for IR adoption. The second is cultural shift and resistance. The challenges are deep-rooted reporting practices, where many organizations have long-standing traditions of metric in their reporting. For the transition to a more integrated approach requires a fundamental cultural shift. Next is the resistance to change, where employees, especially at the managerial level, may resist the change due to a lack of understanding, fear of the unknown, or a perception that the new reporting method might jeopardize established practices. Well, the analysis for this is that resistance to change is a common challenge when introducing new reporting methodologies. Successful adoption of integrated reporting requires effective change management strategies, including comprehensive training programs and communication initiatives. Companies need to invest to foster a more integrated mindset. This involves not only educating employees on the benefit of IR, but also creating a supportive environment that encourages open communication and innovation. The third is that operational challenges. The challenges are resource intensiveness, where companies may perceive integrated reporting as resource intensive, requiring additional time and effort in setting appropriate KPIs, identifying risk indicators, and measuring non-financial data. Next is difficulty in defining relevant KPIs, where determining which non-financial metrics are truly key to demonstrating value creation and aligning with strategic goals can be challenging. Analysis of this is that companies need to invest in building capabilities for integrated reporting. This involves providing training to finance and reporting teams to enhance their skills in selecting relevant KPIs and understanding non-financial metrics. Developing industry-specific guidelines for KPIs and providing tools for measurement can ease the burden on the companies. Collaboration between industry, association, and regulatory bodies can facilitate the creation of such resources. In summary, addressing these challenges requires a multifaceted approach involving cultural transformation, regulatory alignment, and operational capacity building. The success of integrated reporting adoption depends on creating an environment that supports change, provide inventive, and equips organization with necessary skill and tools. But that is not all. The fourth challenge is that stakeholder engagement, where engaging stakeholders effectively in the IR process can be challenging. Companies may struggle to identify and prioritize the diverse interests and expectations of stakeholders. The analysis in this is that integrated reporting aims to provide a comprehensive view of an organization value creation, which necessitates understanding and addressing the concerns of various stakeholders. Lack of effective engagement can lead to incomplete or biased reporting. The fifth challenge is that technology and data management, where many organizations face challenges in integrating and managing the diverse data required in IR. Legacy systems and insufficient technological capabilities may hinder the effective collection and analysis of both financial and non-financial data. The analysis of this is that integrated reporting demands a comprehensive approach to data management, including the ability to collect, process, and report on both financial and non-financial metrics. Inadequate technology infrastructure can be a significant barrier. The last but not least is that education and awareness challenge, where a lack of understanding and awareness among key stakeholders, including employees, board members, and investors, may hinder the adoption of integrated reporting. The analysis is that successfully implementing IR requires a fundamental understanding on its principles and benefits. Without awareness, decision makers may not fully appreciate the value of transitioning from traditional reporting practices. Next, we move on to opportunities of integrated reporting. First, expanded role for accountants, where the adoption of IR necessitates a broader view of an organization value creation, requiring accountants to go beyond traditional financial reporting. This presents an opportunity for accountants to play a more strategic role in helping organizations identify, measure, and report on a wider range of financial metrics. The analysis is that accountants can become key contributors to integrated thinking by actively participating in the identification and measurement of non-financial indicators. This expanded role enhances their strategic importance within organization. The second is that increased relevance in decision making. The opportunity is integrated reporting provides a more comprehensive and integrated approach to reporting, aligning financial and non-financial aspects. This offers accountants the opportunity to provide decision makers with a more holistic set of information for strategic decision making. The analysis is that accountants can leverage their skills to ensure that decision makers make access to relevant and timely information, contributing to more informed and strategic decision-making processes. The third is that demand for expertise in non-financial metrics, where the emphasis on non-financial metrics in IR creates a demand for expertise in areas such as sustainability, social responsibility, and environmental impact. Accountants with knowledge in these areas have the opportunity to become valuable contributors to the reporting process. The analysis on this is that accountants can acquire expertise in non-financial metrics, positioning themselves as essential contributors to identification, measurement, and reporting of these critical indicators. The other opportunities that we can see is that number 4, strategic business partnering, where the IR encourages a more integrated approach to business, aligning financial and non-financial strategies. Accountants can seize the opportunity to become strategic business partners, actively participating in the formulation and execution of organizational strategies. The analysis in this is that by actively engaging in integrated thinking and strategy development, accountants can position themselves as strategic partners, bridging the gap between financial considerations and overall business objective. Number 5 is promoting accountability and transparency. IR emphasizes transparency and accountability, creating an opportunity for accountants to champion these values within organizations. They can actively contribute to the development and communication of a more transparent and accountable organizational narrative. The analysis is that accountants can lead efforts to enhance the credibility of financial and non-financial information, fostering a culture of transparency and accountability that aligns with the principles of integrated reporting. Last but not least is the opportunity of IR is it can enhance value proposition for accounting firms. Accounting firms that position themselves as experts in integrated reporting can differentiate their services. They can offer specialized consulting and advisory services to clients seeking to adopt IR. The analysis in this is that accounting firms can leverage their expertise to provide valuable guidance on IR implementation, offering a unique value proposition that goes beyond traditional auditing and financial reporting service. In summary, integrated reporting offers numerous opportunities for the accounting profession, ranging from an expanded role for accountants to increase relevance in decision making and the potential for career advancement. Embracing IR practices positions accountants as strategic partners, contributing to the overall success and sustainability of organizations.
Next part is theoretical framework. The first one is political economy theory. Political economy theory is defined as the social, political, and economic framework within which human life takes place. The perspective embraced is that society, politics, and economics are inseparable, and economic issues cannot meaningfully be investigated in the absence of considerations about the political, social, and institutional framework in which economic activity takes place. It adopts a similar perspective to legitimacy theory with respect to the function of the annual report and a firm's reason for disclosing information. Variation between legitimacy and political economy theory. The second theory is legitimacy theory. Legitimacy theory is based on social contract between a business as a social institution and its environment and society where it operates. Legitimacy theory aims to explain the limits of acceptable interaction between organizations within society and community. According to social contract theory, corporate management seeks to meet society's expectations, thereby gaining organizational legitimacy. Legitimacy theory asserts that organizations continually seek to ensure that they are perceived as operation within the bounds, norms, and expectations of their respective societies. The difference between political and legitimacy theory is that political economy suggests disclosure is preemptive and used to enforce an agenda to stave off intervention, while legitimacy theory suggests that the firm is responding to show that its actions correspond to social expectations. When actions and expectations diverge, the company educates the community. In other words, legitimacy theory suggests that the firm is reactive to social change, whereas political economy theory suggests that the firm is a proactive, powerful participant. The third theory is stakeholder theory. The stakeholder theory, which often traces back to the work of Freeman, sees an organization as not only responsible to shareholders, but it also has responsibility towards other stakeholders. Instead of society, only a particular stakeholder groups are considered. These stakeholder groups demand different information, and firms will respond to their demands in a variety of ways. It is a theory of organizational management, which is positive theory, and business ethics, which is moral or normative theory, that addresses moral and values in managing an organization. The moral or ethical or normative perspective of stakeholder theory argues that all stakeholders have the right to be treated fairly by an organization, and that issues of stakeholder power are not directly relevant. It is assumed that management should manage the organization for the benefit of all stakeholders. Disclosures are considered to be responsibility driven. The managerial or positive perspective of stakeholder theory tends to be more organization centered. The organization tends to satisfy the information demand of shareholders that are important to the organization's ongoing survival. A stakeholder's power to influence corporate management is viewed as a function of the stakeholder's degree of control over resources required by the organization. The last theory is institutional theory. Institutional theory views the organizational response to its environment based on three pillars: coercive, mimetic, and normative. Institutional theory is a theory on the deeper and more resilient aspects of social structure. It considers the processes by which structures, including schemes, rules, norms, and routines, become established as authoritative guidelines for social behavior. Pressure from the stakeholders who expect to see a particular practice in place. It shares much in common with legitimacy theory in that it understands that institutions must interact with its surroundings social systems. However, it is much more interested in what this means for the structure and conduct of the institutions than it is in what it means for society.
The first solution is government leadership in public sector and government-linked company. Although the IRRC believe that governments should not control integrating reporting since it must be driven by the market, the government must regulate how integrated reporting is implemented in Malaysia. Thus, it could be best for governments to set the example by implementing integrated reporting in the public sector and in government-linked company. Next, addressing challenges through human capital culture. The problem with integrated reporting can be lessened if organizations follow the guidelines for creating a strong human capital culture. This will help to solve the trustworthiness issue raised by IR critics and prevent the problem of form over substance. The third solution is integrated thinking in organizations. Changes such as the introduction of new disruptive technology, changes in consumer needs, desire and behavior, changes in the influence of stakeholders within the organizations, the need for a skilled workforce, employment trends, and population and geopolitical shift are all revealed by integrated thinking in organizations. To provide stakeholder relevant information, organizations must connect the dots between strategy, risk, business model, and KPIs. This is done by establishing connection between the relationship between capitals, input, outputs, outcomes, and impact. This will enable organizations to be resilient and sustainable for the foreseeable future. Next is empirical demonstrations of IR benefits. Each stake works to objectively prove the advantages of integrated reporting generally and from an Asian viewpoint. Research may be done to determine what factors contribute to the acceptance of integrated reporting in particular contexts, as well as what approaches are used to expand and introduce RR practice in various institutional settings. The next solution is understanding stakeholder needs. Investigating the kinds of corporate information that different stakeholders need is another potential field of research. Integrated reporting needs to be able to connect the dots between what stakeholder wants to hear and what firm want to say. It needs to be two-way, with the goal of the integrating reporting being to provide stakeholders with information they can use to make decisions, not just a ton of information. The other solution is focus on value for society. In order to fully realize the goal and function of integrated reporting, a true understanding of the connection between companies and stakeholders is required. In addition, research is being conducted to determine why certain stakeholders are opposed to integrated reporting while others are willing to embrace it. and why integrated reporting concentrates on its concept of value for investor rather than value for society. Next, establishing best practice and methodologies. In order for integrated reporting to have a significant impact, it is required to determine best practice and implementation techniques, ensuring that stakeholders and organizations both recognize the value of integrated reporting. The effect of integrated reporting on business value or other metrics is another topic of study utilizing quantitative techniques. The second last solution is collaboration for integrated reporting literature outputs. Researchers, businesses, regulators, and accounting firms that collaborate will be able to produce the three main outputs of the literature on integrated reporting. Case study for educational purpose, practical application for industry and practitioner, and in-depth academic research that examines empirical research using theories and by verifying or disputing hypotheses. Last but not least, education of stakeholder. Even though integrated reporting is not required for listed firms by SC or Bursa Malaysia, stakeholders should be told to promote its importance. Malaysia is striving to be among the elite group of preferred countries in this region, and with the establishment of the Asian Economic Community, it is now imperative for Malaysian organizations to carve out their niche rather than questioning whether they can or should comply with IR.